this is all about trusts, which is my view of what the best way to do it is. I've had quite a bit of experience, so there's a little bit there about me, and trust is one of the things that I've specialised in for quite some time, as well as knowing a lot about tax and how to set up structures and business development. Necessarily, you have to have a disclaimer to say that everything you hear today you can't rely on. You need to come and talk to me specifically, and then you can rely on it. But of course, we are trying to give you information that is relevant and helpful. Now, one of the things that you need to consider when you set up a structure or say, how do we do this investing? You want to maximise your flexibility. You want to minimise and ring-fence your risk. Minimise your compliance costs. That's for people like lawyers and accountants and others. And you want to maximise the benefit after tax. Although I'd have to say, while that is there, that's a nice outcome, but you don't do it because the tax is going to be saved, because politicians like to tinker with the tax system. And at the moment, of course, they've got the tax working group that might do all sorts of things. So tax rates change, so the benefits you might get today might not be there tomorrow. And in my view, for the style of investing that Joy has been talking about, the ideal structure is a family trust or trust. Now, the purposes of that are to protect your personal assets. Many people are involved in a profession like accounting, legal, engineering, architecture, whatever, or have a business in any kind of activity that carries risk. So the goal of those businesses, while it provides income along the way, it's actually to produce a nest egg that you can have there for retirement. And you want to keep that safe. So as you develop that, you keep it safe and put it aside. You want to provide flexibility for changing circumstances. Today you could write your will and say, I want to leave my assets in the following way. And actually you look back at one you did 5 years ago and you say, I did that, because circumstances have changed. And if you're a younger person, you might have more children. If you're an older person, you might have more grandchildren. One of your children is married, their partner gets, or husband gets killed in an accident, and suddenly they have a greater need than you've allowed for. And actually saying, this is the way we want to split it today, doesn't work later. Provide education fund for your children or grandchildren to help your family, help them buy a house because they live in Auckland and they can't get a house any other way. It can be the long-term super fund. So over and above KiwiSaver that you might have, you say, right, we want to invest for the longer term, and this is where you should do that. And sometimes if you want to be really kind to people, you can be philanthropic and give chunks of it away at the other end, or even along the way. Assets that you would typically put in a family trust: the family home, life insurance, your investment portfolio. If you've got surplus cash, that should be where it's held. Don't leave it in the business or your professional accounts. Listed shares, fixed interest, unit trusts, unlisted shares, and rental properties, particularly if they are producing a positive return. And then if you've got any valuable heirlooms, art or antiques, that's where those should be too. Some people have those, not everybody. Now, I need my staff tell me I need to explain this. This is me doing my simplistic thing. There are 3 parties involved in a family trust. One is called the settlor, and sometimes that is a husband and wife, so there are actually 2 of them, or partners. Those are the people who actually transfer assets into a trust. So that's their role. And sometimes that's the only role that they have, is to transfer assets into the trust in the first place. Then there's a group, usually a group, of people called trustees who manage the trust on behalf of the beneficiaries. Their role is to look after it, and they have to take account of the interests of the beneficiaries along the way to make sure that they do what's right between older beneficiaries, younger beneficiaries, to account for splitting things up later on. They have to honour the terms of the trust deed, and they have to consider all the circumstances and position of the beneficiaries. Decisions, unless the trust deed says otherwise, the decisions need to be unanimous, which is a safeguard. Can also be occasionally a problem, but if you have an impasse. But decisions requiring unanimity means that you can't have one or two trustees going off and doing something that is crazy that might prejudice the interests of some other people if you've got a third trustee who's there. My strong recommendation is you need an independent trustee in there. Somebody who's not a member of the family, who can make sure that you don't do something really crazy. Fail safe, I'm going to invest in this Argentinian gold mine. No, I don't think you should go there. The third group of people is the beneficiaries, who are the people who are going to get the benefit of the trust, either along the way as it makes income year by year, if it's for children, to pay the school fees, to pay for the trip overseas, to the school trip overseas, pay them through university, to tech colleges or whatever. And later on help them buy the house, and to help, and ultimately when the trust winds up, to split it up amongst them and give. So there are groups of beneficiaries. Usually, if these people are older, a couple who put assets into a trust, they will be beneficiaries, and they may well be the main beneficiaries along the way, because it's their super fund. And when they're gone, the kids can have it. But they may well help the kids along the way. Trust law, like tax law, keeps changing. The Law Commission has been working on for the last 3 or so years changes to trust law. There's a draft trust bill out now that is going to change it, but this is going to keep changing, and it's not actually the law yet, so it could still change before it becomes that. So changes are likely to mean that beneficiaries who are identified in the deed are entitled to get information about the trust, and maybe more information than they did in the past. And also that the beneficiaries may have some more power to get rid of trustees who are not doing their job, either because they're incompetent or they're lazy or whatever. At the moment, it's very difficult to get rid of a trustee unless they're dishonest. So the law changes, it's going to keep changing. And probably also courts are instrumental in making some of those changes, in that they look at what's called trust busting, which is where, say, a relationship breaks down and there's a family home in the trust. And they say, it doesn't matter what the trust deed was, whether the house was bought before or after before the relationship started, we're going to split it half each. So it doesn't matter what the trust says. And also, if somebody goes broke, then the lawyers, the big legal firms around town will say, how can we access that trust to help cover some of the losses that everyone else is going to suffer? As the set law, you hand over control to the trustees. So there is a legal separation of those assets. However, the set laws often retain the right to appoint new trustees. So, and I've seen a couple of cases where people have appointed friends. In fact, both cases they were lawyer friends. Oh yeah, good friends. And actually, it was the worst choice they could have ever made, because they were not on the same page. They were never going to actually ever reach agreement. In the end, they had to say, okay, this power is the power to hire and fire. So for no reason, you can get rid of a trustee if that is written into the trust deed. So that can be important. Or somebody becomes mentally incompetent to perform the duty, or becomes insolvent. And you can also have that power in the will. So you can say, right, after my death, the people responsible for my estate have the right to appoint trustees. and that's important as well. They can also be a trustee. So typically, a husband and wife setting up a trust, the way that I would recommend it is they are both trustees together with an independent person.
Both accept this.
Yeah.
And then trustee.
Yes. And then later on, if one of them dies or they both die, then you look at who are the suitable children to appoint in their place. And not every child is suitable. Some of it, they need to be impartial and trusted by the others. And then the other thing, just to protect the settlor, is that sometimes you gift off the assets to the trust, but if you don't gift it all and still leave money owing to you, you can still hold your hand out. So even the trustees aren't quite doing what you want, say, right, I want my money, please. So you can then grab that bit of money back. So it's a safeguard. Pitfalls: trustees becoming incapacitated or insolvent. Disagreement among trustees leading to impasse decision making. I've experienced that personally in a recent experience, and that's very difficult. So the only outcome there is an arbitration clause in a trust deed or going to court. And usually going to court's not worthwhile. Now, a trustee doesn't have to be an expert. So you can say, to be a trustee, do I have to be a lawyer or an accountant or know lots about trust? No, you don't. What you need to be is somebody who is sensible, good at making decisions, and good at taking advice. Because all the trustees might be none of those things, but they can always hire the advice that they need and say, I don't know what to do here. What do we do as trustees? And go and ask for legal advice or accounting advice or whatever, and say, right, okay, now we've got that advice, now we can make our decision. The trustees also need to be of a similar mind, that if a husband and wife who have got assets in a trust want to make a decision, we want to move from Wellington to go and live in Tauranga. You're not going to have a third trustee who says, no, I don't agree to you going to live in Tauranga and buying a house up there instead of down here. So, you know, a third trustee is there to protect but also support what is happening within the trust. Making sense over that? Inadequate controls over investing the money. If you deal with somebody like Joy or investing your money, the trust will need to work out what its risk profile is, whether it wants to be a high risk, low risk, and will establish that, and then it needs to establish the right relationship with an investment advisor. Because most trustees are not investment advisors, so they should not be making the trustee investment decisions. Not considering particular needs of the different classes of beneficiaries. You've got an older beneficiary who's a widow, say, towards the end of her life, her husband's already died, she needs income to support her in her lifestyle. The younger generation, they don't really want to invest the trust to generate maximum income, they want to generate growth because the growth is going to benefit them. So there you have different competing investment criteria that actually, so the trustees have to make a decision, and therefore they will have to have a balance between giving income for one class of beneficiaries and capital growth for another. Relationship breaking down. Husband and wife setting up a trust should regard it as, if it breaks down, you get half each. And the way to do it normally would be to set up two separate trusts at that point. The question is, can I put all the assets into a trust, or do I have to put it in and gift it off? Okay, the answer is yes, you need to put the assets in, whatever assets you want to put in, which are the house and the portfolio or whatever, into the trust. At that moment of time, the trust owes you that money, whatever the value of that is. Now, you have an immediate option of gifting that whole amount.
Now that's the thing, you can gift the whole amount?
You can gift the whole amount, and that will not have, there's no gift duty. Gift duty stopped in 1993, I think it was. So there's no gift duty anymore. And effectively, if you wanted to protect your rest home subsidy, you're probably not going to go there anyway. But if you gift off more than 13,500 each, you potentially lose your rest home subsidy, but you're probably not going to get it anyway, and by the time a few more years have gone past, you're not going to have it anyway because the government won't be able to afford to give you the rest home subsidy if you've got assets in a trust. So at the end of the day, if you've got significant assets, you should regard yourself as being responsible to pay for your rest home care, because the government's going to see to that before too long. The gifting off, yeah, so the gifting can be immediate. There's no limit, there's no limit. The only limit is the comment that I made earlier, which is you may want to leave some owing to you. There is a view that it's actually sensible to leave some money owing, so even if you make a, let's say you put $2 million worth of assets in there, you might leave $500,000 as ungifted and gift 1.5, so that at any point, without anyone having to do anything, I want 500,000. And they have no basis not to do that, even if they have to sell some investments or whatever to do that.
So why put it in a trust?
Because this is an exceptional situation. And so what you're doing is saying, okay, you need to provide some protections for those exceptional situations. And a trust is a good way to cope with flexibility over decades, but still, you still need to be a bit of sensibleness in there. Now, I've used the word passive here, and I've had it redefined for me today. Passive is, shall I say in my context, is the opposite of active. So typically the income will be from non-active, so you don't do trading in a trust, in this kind of trust. So it's interest, dividends and rents will be the sort of income that you would expect to earn. Now you need expert accounting and tax advice. In case you don't know, a trust pays tax at 33% unless the income is allocated to the beneficiaries on an annual basis.
If it's in a pie, it's 28 cents.
Sorry, if it's in a pie, it can be fixed at 28 cents, but then you can't allocate it and get savings. So, so I've ignored the pie situation here, but that could be worth considering in some cases. And I'm now about to show you why in some cases you can get significant benefits from a tax perspective. Let's say, for example, a trust earns income taxable income 100,000 and doesn't allocate it, it will pay tax of 33,000. However, let's say there's a husband and wife and they've got 3 children, 1 who's over 16 and 2 who are under 16. The under 16 bit is that you can only allocate $1,000 to an under 16-year-old under current law. So because the breadwinner we have assumed is already earning over 70,000, we're not going to give him anything. The spouse has no other income, so we're going to give her 70, which is where the maximum tax rate comes in. So the tax on that's 14,020. Child 1, 28,000, and that's really determined by the fact that these two can only get 1,000. So we've allocated 100,000 to the best tax advantage, which gives that amount of tax and a tax saving between that and that of 14,850. Round number is $300 a week. And so, that's worth having, isn't it? But let's say later in life, you and your wife, and your only income is New Zealand Super, and I've just rounded that off as 20,000, and said, okay, we've got the same $100,000 worth of income, so we'll give you 50,000 each. The extra tax on the 50, over and above the tax you're going to pay on the 20, is 11,500. So that total is 23,000, and there's a $10,000 saving. So that's $200 a week. So as I did in one other case where there's a family trust that I'm a trustee of, even though we don't do the accounting work for it, I said, well, why don't you allocate some of the trust income to the widow in this case? Because that will save tax, and it actually saved, the tax saving was greater than the annual accounting fee. You say, actually that, and the accountant should have thought of that in some ways, but so a pie can also, as a 28 cent, can also be 0, which is the way that you would do it. Yeah. Trust setup, we can do that. Trust record keeping, we can do that. And these days you can do it electronically. So you have trustees in different parts of the country. You can do it electronically online and e-signing, a bit like the IRD tax returns now. But you need trust advice on financial decisions, and that's also what we do. The other bits that we do, structuring, gifting. So if there is gifting, we do that. Annual financial statements, tax return, and business development. So we're not just bean counters. Those are my contact details, and Julie over here. If you want copies of the slides, which will include Joy's slides, contact Julie and she will organise those for you. So in a way, what you should regard the trust as is, using the word, a living will. It's like you put your assets into another entity that's like you, alive, with flexibility along the way, without having to keep changing the actual end of life thing. And those assets can also be dealt with after you're gone. So your will would typically say, if the trust owes me money, we write that off. And this is what I would like to happen. I would like the new trustees to be so and so and so and so. And my wish is that you wind the trust up. And that will be a typical. Or when my other spouse has passed away, then I would wish it to be wound up. It's not binding on the trustees, but typically as a trustee, if there is such a document, typically called Memorandum of Wishes, but it can be part of the will, then the trustees would normally try and honour that, unless there is some good reason not to do so, like the person's died, for example, would be a typical example, or if they were, maybe they were demented, you know, so actually they weren't able to, so actually somebody else would have...
So it would be a very good reason for them not to actually...
Yeah, so it says, right, that's what I'd like you to do, yeah. But if there's a reason not to do it, a better reason that the person didn't know back then, but because circumstances had changed, then you could do it later. Anyway, that's enough for today, isn't it?
Thank you.
We're happy to hear from you later if there is any clarification that we haven't covered. You say, what did he say about that? Come back to us or to Joy. So thank you for your attendance. It's great to have you along. Thank you.